$1,000 account, we are positioning each trade to risk 1%, which is $1,000.
Yep.
So everything that we've done in terms of basing all of the data here is position sizing to our loss at a rate of, if it goes all the way to our loss, we're only going to lose 1% of our account.
Gotcha. So the stop price is always going to be at 1%. So that's even.
No. The stop price is not at 1%. The calculation is your entry point minus your stop price gives you a dollar value divided by 1,000 gives you your shares.
Right.
So the thing that changes every single time is the position size. So this is not a every time buy 10 grand. So you'll notice with NVIDIA, we're only buying $5,700 because we're actually going for a bigger target and we have a bigger stop. Whereas if you look at Lit, we bought 14,000 because our stop price was closer, right?
Okay.
So you're keeping your risk the same on every trade is really what you're doing.
Okay,
so
but when I look
at it from an options standpoint, Adam, you would say you buy 1% of your account in each option every time. That's how you would manage your risk.
No, I got you, but always when it's a loss, it's exactly $1,000. So we've had 3 trades, Docu, Dell, and Len, be losses, and those are always at $1,000.
Yep. That's what that should be, because we get stopped out at the $1,000 loss mark.
Okay.
Yeah, I mean, you can make that whatever you want. It's just we built a simulated $100,000 account. So 1% of $100,000 is $1,000, and that's where you should get stopped out every time.
Gotcha. No, but that's what I'm trying to say, and that's what I don't understand, because we get the stop loss prices, and where do those come from? So can we go through that again? Like, the pattern.
That's off the chart. So here, okay, let me share my screen because that's actually more. That's the more value. Okay.
If you can record that would be great, and send that to me, just so I have like a understanding.
I'm just going to keep going over this until you have a full understanding, because I want you to fully understand what you're building. So let's take...
Go slow, because you understand it much faster than I do.
So let's go ahead and let's pick, I don't know, we'll pick JD, okay? Here's the pattern that I'm looking for. I am looking for a series of higher lows. So let me clear all these drawings off. And let's go back in time on this. And let's pretend that we're right here, okay? And I will go ahead and actually grab this as a screenshot for you. And I'm going to...
Before we get there, you find those patterns that you'd like to see inside of FinViz, right? So we went over that, where you find those patterns in FinViz. Now, out of the ones that you pick out of FinViz, what is the logic there on which ones get picked? So you look for ones that have this certain type of pattern.
It's called an ascending triangle pattern. Ascending triangle pattern is pick number 1. Second is Darvas box. Okay, I'll explain the difference between the two, and I'll explain the logic of why they work. Okay, you have 3 things that a stock can do, right? It can be going up, it can be going sideways, and it can be going down. That's it. Those are 3. There's literally only 3 things that a stock can be doing. When a stock is trading in a range where there is a ceiling to it, okay, this is called a flat top, meaning the market is, every single time price gets to 85, they're selling it. Now, the ascending triangle is a series of higher lows. So you have a low, a higher low, and a higher low. And what that's saying is every time stock comes, the price falls, buyers step in sooner and sooner and sooner. So they're winning the battle under the surface. When this breaks out, it has a higher propensity to follow through because buyers have already showed over the last month or 2 that they are not waiting for price to fall back to the same level. They're picking it up sooner and sooner and sooner. And then when you get a breakout, you tend to get these big explosive moves to the upside like this. All right. An example of a range where you're just trading sideways for a long period of time would be, let's say, I think it was FICO, okay? This was one that we looked at. All right, this is clearly trading in a range. Okay, every time it falls down into this zone, buyers step up, and every time it pops up into this zone, sellers step up. So price is just going back and forth. Nobody's winning the battle. Okay, we are just looking for a move out of this range, either up or down. All right. Obviously, we're playing things in on the breakout side to make things simple, so we're not looking at it from a shorting perspective. So I'm looking for a breakout. Once it leaves this range, it typically moves the size of the range or a little bit more. It's called a measured move. So this range here is from 380 to 460. It's $80. When this breaks out, it should move up 80 bucks or more. All right, those are how you calculate measured moves. Now, for targets, right, let's go back to JD. And here's where I'm using my last stop. Before the breakout, what is the most recent low? Okay, and so we've put in higher lows here and here. Now that this is broken out, where would I place my stop? I would be wrong now if it broke below this point. Okay, because what that's saying is the market's no longer trending up because it made a lower low. An uptrend and a downtrend are very simple to define. A downtrend is a series of lower highs, okay, and lower lows. That's it. An uptrend is a series of higher highs and higher lows. So this is an uptrend because you have a higher high, you have a high, you have a higher high, and you have a higher high. And you're low, and you have a higher low, and you got a higher low. So that's an uptrend. So as long as it stays above this point right here, trend is higher. And so that's where we place our stops. So if we look at lit, let's take lit, which is on here. Okay, here's what we looked at. I looked for this breakout right here, and I took the most recent low. So our stop loss was going to be at $40.50. The most recent low on here is like right in here. It's about 41. I look at this over here. It's like 41.50. This is called ATR. ATR is average true range. It's the size of the average move that a stock makes on a daily basis. So the average true range is $1. So I actually set my stop $1 underneath of this low because it shouldn't violate that zone. And so that's how I got 40.50. 41.50 was the recent low. I put $1 in there and we got ourselves our stop at 40.50. And our target, 46, 48. 46, 48. And I got that from going from the low to the breakout point with a fib. And it gave me this, and it gave me this. All this is saying is 124% of this move and 200% of this move. Okay, so if this was a $10 range, the first target would be $12.40 above, and the second target would be $20 above. That's all those targets essentially are. And so all I do is I look for patterns like that. I look for setups that are strong. I find the area where I don't want to own it under, where I think we're wrong if it falls below that, and I'm looking for those stocks to make those breakouts and get those explosive moves. All right, let's look at SE. All right, here's my line. It didn't violate it, right? Came down, but it didn't violate it. Our stop loss is 135. The average true range is about $10. We got 155 in here. I give us a big wide stop on this, so we don't have to worry about getting stopped out. We get our breakout. It slowly slides back, but it doesn't break down. It doesn't make a new low. And then we get our explosive move higher. These are the patterns that we're looking for. First target, 195. Take another one that's in here. Let's take EM because it's another one that's breaking out right here. All right, when we put this alert in, right, we're looking for an entry point above 46, okay, which was higher than the recent highs. So our entry point was actually in this zone. Might have been a little bit early, but our stop, when you look at EM, was at 42, the last key important low. Because if we go back in time, this is what the chart looks like. Where's the most recent low? It's all the way back down here. All right. Now, where do we get our targets from? Our entry points here, our stop is back here. Our targets on this, 49, and the other one's not in the in there correctly. And so target 2 is listed at $9.50. But here's our breakout, 49.52. So this should be 52. All right, that's how we did that. That's how I got up to that. Good looking chart pattern, making a breakout, right? We buy it over the new high for the recent time. Our stop is nice and wide so we can get a full move. And here's our breakout. It looks like it wants to turn around and start going.
What's the time frame that you're looking at that? So what is the recent time? Is it the 180-day moving average, or what's that?
No, there's no moving averages on this chart.
90-day?
There's no moving averages. I'm just purely looking at stock patterns. And that's part of the reason why some of these sides of these moves vary differently. Here's NVIDIA, right? NVIDIA needs to make the break over here and hold over it for the close. It's, 570. All right. If I look at what we've put together here, we're looking for this move, which gives us these big upside targets. Okay. 690, 765 didn't draw this way exactly perfect. So on a percentage basis, right. So again, think about it like this. So I mean, the math calculation is this. This is the box. All right, that's what we look at. This is the range that we're trading in. The size of this move, whatever this is 112 points. Okay. All the calculation is with a fib extension, this is 112 points. We're multiplying it by 1.24. 138 plus our breakout spot, which in this case, was whatever we called it, 573. That's how I'm getting my target. Okay, that's it. All right, the second target is 2 times it. So, again, by that same kind of logic, whatever this was like $110. Multiply it by 2, 220 plus, 573, right? That's about what we should be getting. Right, when I go and I do this, I make sure that my numbers are exact. I'm just kind of quickly going through these things for you guys, but that's the calculation. Yeah, the line was back down here. That's the reason why. But that's what we're looking for. So something that's trading in a very small range, right? When that breaks out, it's not going to move as much. Like the rubber band isn't as stretched. It's not as explosive as a move. It's going to be a smaller move, right? So, again, take a look at something like lit. This made a nice size move, but look at it on a percentage basis from the breakout. 6%, 11%. That's because this range was really small. When we just talked about that NVIDIA move, if we're going to capture this, we're looking for a 25% move. But that's because this range was 25%. So the size of the range in front of the breakout is going to determine how far that breakout is going to go. And that's the reason why when you look at our setup, NVIDIA, we're only putting $5,000 into, where lit we put $14,000 into. It's because the size that we were looking for in lit was 3 times smaller than the move that we're looking for in NVIDIA. At the end of the day, we're going to make the same amount of money on this 7% move as we're going to make on this 20% move because of our position size. All right, put 10 grand into something that moves 20%, you're going to make $2,000. Put 20 grand into something that moves 10%, you're going to make $2,000. That's the logic there. And every stock moves differently in terms of its size. I mean, something like Tesla, for example, the size of this range in here is 50%. I'm going to need to give it a big wide stock with a very small percent because this thing can really run. I mean, look at the last breakout. It went 170% higher. All right. On the flip side, if I'm trading something like the EM, which is the emerging market ETF, this whole move is like 8%. So I can put a lot more money in this than I can put in Tesla. And that's the thing a lot of people don't know or understand about risk management. They think you put the same amount of money into everything. Stocks move wildly different based on their what's called beta. That's what it's percent move against the overall market. So a stock with a beta of 1, if the S&P goes up 1%, it should go up 1%. Stock with a beta of 5, if the S&P goes up 1%, it should go up 5%. So a lot of times when you're trading the higher volatile names, those are the ones that are moving, but they can go up and they can go down a high percentage. And that's why our position size is the most important thing that we're kind of teaching people in terms of how to use this. And you can see it wildly, very differently between the different pieces. Look at the completed trade, right? Look at the amount bought. Fan, we bought 30 grand worth of it because the entry point and the stop loss was 50 cents away from one another. Right.
So, like on the stop loss, getting that price, I'm still confused how we get that price.
Okay. Because stop loss is the area where we think we're wrong on this. Okay. So if I'm really just kind of looking, and I'm going to try to make this as simple as possible. Please ask questions if you don't understand it. This is the range that we have. Right. When I was looking at when I was looking at EEM, this was the range that we had in play. Okay, it was this box. This is what we had. For the last 4 months, price traded inside this zone. You see it hung around on the bottom, it pushed up at the stop and failed, fell back to the bottom and started to push back up. When it was about right here, that's when we added it to the alert list. I said if it got above the top of this box, I would want to buy it. Now, where am I wrong? If it comes up and it falls all the way back to right here, am I wrong? No, I'm only wrong if it makes a lower low. So I took the most recent low and I put our stop underneath of it. And I gave it a little extra space. So we're in this until it breaks below this line down here. So the easiest way to think about where we put our stop loss, we put it under the most recent low. Because if we're trading something in an uptrend is a series of higher lows and higher highs. As soon as we don't have a higher low, but we have a lower low put in, we're no longer in an uptrend. And therefore, we don't want to be a part of this stock. So every single one of those, when we look at them, we use that same kind of logic. Look at CPRT. Well, our entry point was here on this particular one, $108. Where was our stop? Our stop was underneath the most recent low, which was like 100. So our stop on CPRT was $99 a share. So we put it again a little bit underneath. So we actually put the stop right down in here. Oops. Instead of exactly on this number, we gave it a little extra space, which is what we're going to do every time. All right. So it was here. So our entry was if it broke out, and we don't want to own it if it breaks down. And it's just that simple. And look what happens on this. It acts exactly the way it's supposed to. It comes up to the first target. You took your profit, fantastic. It comes back, and what does it do? It tests the breakout zone, and it holds. This is what you want to see happen. And then what does it do? It shoots up and goes to the second target. Perfect. Now, if you're looking for what you want to see happen next, you want it to come to here and then go up. It's a stair-step pattern. And as soon as you make a lower low, you're out. So now, if we were entering the trade now, our stop wouldn't be back down here. Our stop would be underneath of here because this is now the most recent low. When we put this together, this was more of a box than an ascending triangle. But yeah, I mean, market is a high, market is a low. We want to own it over the high. We don't want to own it underneath the low. And then as time goes on, charts change. So again, originally when we entered it, this was the low zone because that was the most recent low. Now, if we were looking to buy this, okay, moving into the future, what we would have been looking for was we would have been looking for a break over right here, and our stop would now be here instead of back down here because the market is put in a higher low. So this would have been something we would have added back to the alert list in on this day, saying we'll now buy it over 118, and we'll do the same kind of calculation. We'll take the most recent low, we'll take the breakout spot, We'll put this together, we'll draw our fib, and our next target would be 130, and our stop would be 107. So if we were going to enter this trade in now, that's what we would do. So all we're doing is we're looking for things that are trending up. We're taking the most recent low, we're sticking our stop underneath of it, and we're looking to buy the breakout. And we go with it until it stops working. Okay, sure. So let's come in and let's look at, we'll pull FinViz back up. All right, so we come in here, we go to our screener. All right, so again, simple screener that we're looking at mid caps and bigger. We're looking at things that are optionable, okay, so that the options players can play. We're looking at things that have good volumes, over 1 million shares. We don't want to play illiquid stuff. And then we're looking at things that are right near 52-week highs. And we get this big old list, okay? A lot of these have broken out in the last couple of days. Let's just pull, we'll just start pulling different ones up. Let's pull up some of these, and I'll just keep pulling charts up until I see something I don't necessarily like. Here's Cube. This one looks pretty good when you're zoomed in like this, but then it doesn't look so good when you back it up, because what do we got? We got major all-time resistance right here, okay? Price is a memory, and this is what is very hard to teach the computer to do, because this is from 2 years ago. I'm looking at 3+ years worth of data. You know, that screener thing's looking at 52 weeks. This is going to be a problem. This is going to be tough to break through, okay? So if I put an alert to buy it right here, I'm putting our clients in the position where they are now buying it into the biggest, heaviest, most difficult area to own it. Because a lot of times these things come up into resistance and then they fail, and you get a double top.
All-time high, that's the challenge.
That is a challenge. So this particular chart, if I was going to put this together, I would actually look at us to buy it all the way up here on this breakout. So this is not quite ready for us to take a look at. But what I'll do on something like this is I will put an alert to myself, all right, that says, okay, Mike, if it breaks over this level, watch for it to potentially break out. And so if this is trading like a couple weeks from now and it's at like 35.80, I'll probably put that on the list saying we're going to own it over 36.50. It's not ready yet. So it's just kind of marinating, if it is, so to speak. Okay. And so I'll go through all of the setups. All right. So here's another one. This is at 52-week highs. This is ETN. This looks like it is open skies ahead. All right. So now I look at this on a daily basis. Do I have a pattern here that I really like? It's kind of more sloppy than I would like. Okay. It is more of an uptrend just in place and not a breakout chart. What I want to look for is that flat top, a resistance zone that it keeps running into where there's clearly pent up energy, and look for the breakout. So on this chart, for example, you kind of have that back in here in the past where you clearly have a big range that's been in play for many, many months. This is where I want to buy. Okay, so this one wouldn't make my list because I don't necessarily like the way this one looks. Okay, I'll come into the next one in here. Here's Home Depot. I like Home Depot. It's on our list, I believe, right? And here's the reason why. It's a very clear range, meaning there's a lot of pent up energy on both points of this chart. And if somebody can win the battle and bring us above or bring us below, it should go. All right, I'm looking for that pent up energy. So this is a good looking chart to me. All right, let's check out another one. Here's IP. I've looked at this. Again, this is another one that looks good when you're zoomed in, but when you look at it from the bigger picture, there's a lot of resistance at 48. We can't mess with this thing until it breaks over 48. So I set an alert for myself to let us know, hey, Mike, this one might set up in the future. This is one I hate. Here's one that's trading up there. Look at this. This is such a big range for us to try to trade. Look at the size of this thing. This is why we're not trading Tesla. It's the same reason. The size of this range is 25-30%. And it's not a high beta name, not the way that NVIDIA is. But this is just huge. We have a high, we have lower lows that we've put in. Now we had lower highs that were put in. Now we have a higher high. This chart is a mess. It's all over the place. So because it's a mess, I don't have a good setup. So I'm not going to touch this one. Doesn't mean it's not going to necessarily move higher or anything like that. It's just not one that fits into our list of stuff that we want to play. Here's another one, MAS. Same type of thing. We have lower lows that were put in. I don't want that. That's weakness. Okay? I want to see support really lay itself out. Can you guys hold on for 1 second? This is a number I recognize and they're giving me a call. Give me 1 second. Mike, can I help you? Sorry about that. Told him I'd call him back in 10, 15 minutes, but I needed to answer that. So this is not a chart that I like because it's in a downtrend. That's not really what I'm looking for. I'm looking for more of a clean, potential type of breakout. So here's another good one. In fact, we'll add this one. Now this one's not nearly as good as I thought. Same type of thing. Lower lows put in. Held the gap. The only reason I like this is because it's got a very clear top to it. Okay. And if I look at the bigger picture, we do actually have more of a triangle over the course of 4 months. This is why when you really look at like 3 or 4 weeks worth of data, we get a different picture. All right. Trading at all-time highs. We have higher lows put in over 3-4 months. Nice flat top. Let's build this list out. Okay. Like we were going to put this in for the clients. All right. Here's our flat top. Sit at 131.38. So I would go ahead and I'd say buy Nike at 131.50. I want to see it over this line. I want to see it over this line clearly, again, from a closing basis. Now, where do we set our stop? Well, our stop has to be below this. That is definitely the point where the market turned. And there's the gap support that comes in just a little bit below there. So this is 118. This is like 117. I would actually ask us to put our stop a little bit below that, about here. So I call it 116. All right. So it's giving us a little bit of room in case it kind of fakes us out, all right, or tries to fake us out. So it'll give us the opportunity to kind of capture that move. We'll take the most recent low here, and we'll take the breakout spot. Go ahead.
So the stop loss, I see where that's set. Now, how does it always calculate the entry point so that the stop loss is always $1,000?
I'll tell you that. Yeah, I'll tell you that in 1 second.
Okay.
Because that's a good question, and I want to explain that to you. But let's finish this up real quick. So 116 would be our stop at 116. And then our target is going to be, it's 146.94. I'm always rounding these things down because we want to get filled a little bit before the target because other people see the same thing we do. So I put that in at 146.50, and I put our second target in at 155. So that's how I built this out. Now, let's calculate. How do we calculate how many shares to buy so that our risk is always the same? This is a cool calculation, all right? First off, we have to figure out as an individual, how much money are we risking? Well, we've figured that out already, right? We got $100,000 and we're willing to risk 1%. So that means it's $1,000 risk per trade. The next thing that we're going to do is we're going to calculate the stop per share that we're risking. So if our entry point is right in here at 132.50 and our stop is back down here at 116, what do we get? We get $16.50. Okay, so we'll take that calculation out correctly. So 131.50 minus 117 gives us I said 116, right? Yeah, 116. So $15.50. Okay, that's how much each share we buy we're risking. So I take 115.50 and I divide that by $1,000, and it's $1,000 divided by my 15.5 shares. This tells me how many shares I need to buy. I can buy 64 shares. Okay. So what that means is if I buy 64 shares at 131.50, right? So 131.50, we're spending $8,500 roughly. Okay. Now, if I go to sell, right, I sell my my 65 shares at 116. Look what it's worth. It's worth $7,500. So that's how we're always getting to that $1,000 mark. We're taking our entry point, we're subtracting our stop point, and then we're dividing that by, or we're taking $1,000 and dividing it by that, and that tells us how many shares to buy. And that's why it always works out to $1,000.
Okay. Shouldn't we automate that so we don't have any mistakes on that?
It is automated. That is why it's always showing up as $1,000.
Okay.
Yep.
Okay.
Yeah. So all we're putting in is we're putting in the entry price and the stop and the targets. That's it. Everything else is calculated. So it tells us, it calculates the max buy as well, because we calculated that as a 20% difference between the entry point. So we will not buy it above this.
Automatically calculated. Nice.
Yeah. So it's all automated. So JW did a great job with this. So literally,
always going to give us a stop loss in this formula.
What'd you say?
I said, as long as we put in a stock and a price.
Yeah, this is all you need. You need entry, stop, targets. That's it. You need 4 pieces of information, and all of the rest of this is populated.
We need to put in.
Yeah, I have to put in the stop, right? And then it calculates from there what goes on.
Right. So, but okay. Yeah, that's what I'm asking. So shouldn't we be able to calculate the stop?
No. The stop is the secret sauce. The secret sauce is 3 things, right? Our entry point, our stop, and our target. That you can't automate, because that is looking at a chart and making your logical decisions. Okay.
Okay.
Everything else is calculated off of that.
Okay, I got it.
Yep. Okay. Because, so here's one of the biggest mistakes and misunderstandings of the stock market, period. If you've ever read William O'Neill's How to Make Money in Stocks, it's like one of the most sold books of all time. He's got the Can Slim method, and he has a piece in there about risk management, and it says the following: if your stock goes down 8% from where you bought it, sell it. So every stock, he says 8% is where you need to sell it. And that is just such not intelligent thinking. So on this Nike trade, where he would say to put the stop is right here. Okay, so above the recent low, because this is 8%. Let's take Tesla, for example. Let's say Tesla broke out and made new all-time highs. Where does he want to put the stop? He wants to put the stop like right here. Look at the size of this range. An 8% stop does not work for Tesla, right? Every security has its own movement, its own personality, and subsequently every single entry that you take in any single stock, you need to calculate the stop based on its own volatility. And there isn't a good, hard, fast rule that you can ever just institute from a machine learning perspective, because what works for Tesla does not work for GM. It does not work for Amazon. You know what I mean? Like, everything kind of has its own unique setup. And that's part of the reason why all these algorithms and everything else, they're all geared towards super fast trading, right? It's all geared towards that lightning fast trading, because there's not a really good way to program the logic at this point in time against a human being from a larger term perspective, because there's too many different variables. An expert that's been doing this forever is going to be able to take a look at many, many different things. And the rules are not always 100% the same between everything you're looking at. Yes. You could probably calculate it to pick the last recent low and put in, some logic behind it. But what ends up happening is, if, let's say, for example, Nike, okay? Let's take Nike. This is really where we want our stop to be. But let's say tomorrow Nike comes down to here and then comes back up. The machine is going to take our stop from here based on the logic that you've just given it and move it all the way up to here, which screws everything up because that's way too tight of a stop. And it can't figure that out because the only thing you can tell it to do is take the most recent low and then go below it. And as stocks make their gyrations sideways, they might make another little low here, but that's not important. The important piece is here, and I don't know how to make the logic work that way. Exactly. And I don't really know that anybody's kind of figured that one out. Again, all those machine pieces are really for high frequency trading because it's really easy to teach it to do something on a 5-minute chart versus, a 3-year chart investing against 800 different key levels. It's a lot easier to scalp than it is to trade big.
What time period is the box that you have there?
So this whole pattern, all this trading right here is in 2 months. Each one of these red lines is a month of trading.
Okay.
All right. So it looks like it's like the 17th. That's a month of trading, each one of these boxes. So this pattern, while all the trading takes place up here and all the decision making that we're doing, the reason why we're entering it is actually from here. It actually goes back 4 months because we really have a higher low, higher low, higher low. But all of the decisions in terms of what we're entering, our stops and our targets and everything are only coming from, the last 6 to 8 weeks. But the only reason we like this chart is because of what's gone over here. So I think you also could program what goes on right here, but it'd be very difficult to take in multiple years worth of stuff to the left of the chart, which is actually really important because this look is very different than, one of those other ones that we just took a look at that had big overhead resistance. I can't. Yeah. Right. Yep. And there's a number of other things that really play into charts as well that people don't think about. Gaps, for example. There's some charts that have massive gaps all over the place, right? Really volatile. You probably don't want to swing trade those because you can get these huge overnight gaps. So you also want charts to be pretty clean where they don't have a lot of gaps in them. There's like so many different things to think about. So anyways, I would love to continue to work through this with you guys and try to figure out some sort of language that we could put in that would, really permanently put us in a good shape, from an automation standpoint. I just know that regardless of what you build automated wise, you're still going to need a human being to go and take a look because right. I mean, there's 2 other pieces to this as well that, need to be thought about. And Adam, this is really why we really want to work more closely with you and try to get on more calls on a regular basis. I want to teach you how to do this right because I may not be around forever. You know what I mean? Like,
Exactly.
I don't want you to build your business on the back of myself and then I get into a car accident. Then you're fucked. So, our relationship is not just kind of putting these ideas out there, but it's really supposed to be me coaching you in order for you to be able to figure these pieces out. And you absolutely will be able to. If we get on 1 or 2 calls a week and we take 30 minutes to an hour and we go soup to nuts from the beginning to here, I know that I can get you to a point where you can kind of create those alerts on your own, within a couple of month period of time.
Okay.
And I think that's going to be really important because I don't want to be 100% of your business, right? Like I'm happy to help out by all means, and that's really what I'm here for. But at the same point, like I'd love to get you to a point where you can successfully implement this yourself. That's a safety standpoint for you financially, right?
Okay, super. JW, do you have any more questions? Okay.
But yeah, we don't have to have a call with all three of us, right? So if JW, you got time and you want to hit me up, by all means, let's take 30 minutes. Same thing with you, Adam. I'm pretty much in front of the computer all day, every day. So too much. But I'm here all the time. So feel free to reach out. I know it's been difficult to schedule a time where all three of us can get on at the same point in time. There probably isn't a reason, especially as we're moving forward and you're trying to actually monetize this, for us to sit and wait for all three of us to get together. So JW, you got questions, reach out to me. Adam, you got questions, reach out to me. If all three of us can get on, great. If only one of you can, that's not a problem. Let's keep moving forward.
Gentlemen.
You're welcome. You guys have yourself a good day. And again, let me know if there's anything else I can help you out with. And I will start getting more ideas out for you guys. I think we got one really good one out of this call here today. So drop Nike in on that list. And if I see anything else, I'll certainly get it. My goal will be to add 1 to 3 a day again until we run into a point where the market conditions don't look good. And we'll discuss what that means when that happens. All right. Yeah.
All right. Thank you.
Take care, boys. See ya.
Thank you.